The financial markets have always attracted dreamers. From crowded trading floors of the past to today's glowing screens in quiet rooms, the promises remained the same: freedom, independence, and the ability to make money from anywhere in the world. Yet behind this promise lies a brutal reality. Most traders lose, not slowly, but relentlessly. And one of the biggest reasons is not lack of intelligence, capital, or even strategy. It is the time frame they choose to trade. In this documentary, we dive deep into a truth that separates professionals from amateurs, a truth that 99% of new traders ignore, a truth hidden in plain sight on the charts themselves. This is the story of why professional traders quietly master the 4-hour chart, and why they almost never trade the 5-minute chart. At first glance, the 5-minute chart looks seductive. It moves fast, candles form quickly, opportunities seem endless. Every few minutes, price jumps up or down, creating the illusion that money is constantly available for those quick enough to grab it. For beginners, this feels like control. More trades mean more chances to win. More action means more excitement. But the market does not reward excitement. It punishes it. Professional traders understand something fundamental about markets: price is noisy. On very small time frames, price is dominated by randomness. Algorithms, stop hunts, liquidity grabs, news spikes, and emotional reactions collide in a chaotic mess. The 5-minute chart magnifies this chaos. What looks like a breakout is often just a liquidity sweep. What feels like momentum is frequently just a temporary imbalance that will reverse within minutes. This is where most traders bleed. They enter trades based on tiny signals, get stopped out repeatedly, and then re-enter out of frustration. Overtrading becomes a habit. Fees accumulate. Emotional fatigue sets in. Confidence erodes. And slowly the account dies, not from one big mistake, but from hundreds of small ones. Now contrast this with the 4-hour chart. The 4-hour time frame filters noise. It slows the market down. Each candle represents real commitment from buyers and sellers, not impulsive reactions. Institutional traders, banks, funds, and large operators do not build positions on 5-minute charts. Their size would destroy their own entries. They need time. They need liquidity. They operate on higher time frames where price structure actually means something. On the 4-hour chart, trends are clearer. Support and resistance levels are more respected. False breakouts are fewer. When price moves, it moves for reasons rooted in supply and demand, not emotion. This is why professional traders start their analysis here, not because it is boring, but because it is honest. Another critical difference lies in psychology. The 5-minute chart demands constant attention. You are glued to the screen. Every tick feels personal. Fear and greed are triggered every few seconds. You cut winners too early. You let losers run too long. Your nervous system is under constant stress. Over time, this leads to impulsive decision-making, revenge trading, and burnout. The 4-hour chart, on the other hand, creates emotional distance. You are not reacting. You are planning. Trades take hours or days to develop. This forces patience. You have time to analyze, set alerts, and step away. Instead of chasing price, you wait for price to come to you. This single shift changes everything. Professionals also understand probability. Trading is not about being right on every trade. It is about stacking odds over time. Higher time frames naturally improve probability because they reflect stronger consensus. A support level on a 4-hour chart has far more weight than one on a 5-minute chart. When it breaks, it matters. When it holds with authority. Risk management becomes simpler as well. On the 5-minute chart, stops are tight, easily hit by noise. On the 4-hour chart, stops are wider but more logical. You risk less frequently, not more. Fewer trades, higher quality. This is how professionals survive long enough to thrive. There is also a lifestyle element most people ignore. Many retail traders believe success requires staring at charts all day. Professionals know the opposite is true. The best trades often come from waiting. With the 4-hour chart, you can trade alongside a normal life. You can work, study, or sleep while the market does what it will. Alerts notify you when something important happens. Your life no longer revolves around every candle. So why do so few traders adopt this approach? Because patience is harder than activity. Because waiting feels like doing nothing. Because social media glorifies fast profits and flashy scalping wins, while ignoring the countless blown accounts behind them. The 5-minute chart feeds the ego. The 4-hour chart feeds the account. Professional traders are not immune to temptation. They simply understand its cost. They know that consistency is built on discipline, not excitement. They accept that missing trades is part of the game. They focus on clarity, not quantity. The transition from lower time frames to the 4-hour chart is often uncomfortable. At first it feels slow, boring even, but slowly something changes. You start seeing the market more clearly. You stop reacting and start anticipating. Losses become manageable. Wins become meaningful. Your trading becomes intentional. This is why 99% of professionals never trade the 5-minute chart. Not because it is impossible to win on it, but because it demands superhuman emotional control, lightning execution, and near-perfect discipline. Most retail traders are not equipped for that environment, and professionals know it. The 4-hour chart is not a shortcut. It is a filter, a lens that removes distraction and reveals structure. It rewards those who respect time, risk, and patience. It punishes impulsiveness less severely. And over years, not days, it compounds skill into consistency. In the end, mastery in trading is not about speed. It is about alignment. Aligning your strategy with how markets actually move, and aligning your psychology with how humans actually behave. The 4-hour chart sits at this intersection. If you want action, the 5-minute chart will always be there. But if you want longevity, clarity, and a real chance at consistency, the professionals have already shown the path, quietly, patiently, one 4-hour candle at a time. The dream of fast money has haunted financial markets since the first trade was ever placed. It whispers to anyone who opens a chart, what if you could make today what others make in a month? In the age of social media, that whisper has become a shout. Screens are filled with short clips of instant profits, rapid, higher trades, and bold claims of easy success. But beneath this carefully edited illusion lies a reality few are willing to confront. Lower time frames, especially ultra-fast charts, are not just financially dangerous. They are psychologically destructive. This documentary explores how the obsession with speed quietly breaks traders from the inside, not through one catastrophic loss, but through a slow erosion of discipline, clarity, and emotional stability. This is the story of how lower time frames hijack the human mind, and why most traders never recover from their grip. When a trader first opens a 1-minute or 5-minute chart, it feels alive. Candles flicker constantly. Price never sleeps. Every movement feels like an opportunity calling out to be taken. This constant stimulation triggers the brain's reward system. Dopamine flows not just when a trade wins, but when a trade is placed. The act of clicking buy or sell itself becomes addictive. At this point, trading stops being a business decision and starts becoming entertainment. Professional traders understand that the market does not pay for activity. It pays for patience and precision. Yet lower time frames condition traders to believe the opposite. They teach the brain that more trades mean more chances, and more chances mean more money. In reality, more trades often mean more mistakes. On lower time frames, the market moves faster than human emotion can process. Fear appears instantly. Greed follows just as quickly. A small loss feels like a personal failure. A small win feels like proof of genius. This emotional whiplash creates a dangerous cycle. After a loss, traders feel compelled to win it back immediately. After a win, they feel invincible and increase risk. Both reactions are irrational, yet incredibly common. This is not a coincidence. It is biology. The human brain evolved to respond to immediate threats and rewards, not to probabilistic outcomes over long periods. Lower time frames exploit this weakness. Every tick becomes a signal. Every candle feels meaningful, even when it is pure noise. The trader's mind is forced into a constant fight-or-flight mode, flooding the body with stress hormones. Over time, this state becomes normal. As stress accumulates, decision-making deteriorates. Traders start breaking their own rules. Stops are moved, entries are rushed, plans are abandoned mid-trade. The chart no longer represents data, it becomes an emotional battlefield. Traders are no longer trading price, they are trading their feelings. One of the most dangerous effects of lower time frame trading is the illusion of control. Because use price moves frequently, traders feel involved. They believe they are managing trades actively, when in reality they are reacting. This creates a false sense of mastery. Losses are blamed on bad luck. Wins are credited to skill. The feedback loop is distorted. Professional traders know that true control comes from structure, not speed. On higher time frames, decisions are slower but clearer. There is time to think, to plan, to wait. On lower time frames, thinking is replaced by reflex, and reflexes are shaped by emotion, not logic. Another hidden danger is overexposure. Lower time frames encourage traders to be in the market constantly. Capital is always at risk. There is no recovery time between trades. Mentally, this creates exhaustion. Physically, it creates tension. Psychologically, it creates obsession. Many traders don't realize they are burned out until they can no longer follow even the simplest rules. They wake up thinking about charts. They go to sleep replaying losses. Trading invades their identity. At this stage, the market has already won. This is why professional traders are so selective about when they trade. They understand that capital is not just money, it is emotional energy. Every trade costs something psychologically. Lower time frames drain that energy rapidly. Another critical issue is inconsistency. Lower time frames produce mixed signals constantly. One indicator says buy, another says sell. Patterns appear and disappear within minutes. This creates confusion. Traders start system hopping, endlessly searching for the perfect setup that will finally make sense of the chaos. But the chaos is not in the market. It is in the time frame. Markets move in waves. Large players build positions over time. These processes cannot be seen clearly on very small charts. Lower time frames fragment reality into meaningless pieces. Traders are trying to understand a novel by reading one word at a time. The result is frustration, and frustration is dangerous. It leads to revenge trading, impulsive risk-taking, and denial. Traders double down, convinced that success is just one trade away. This mindset keeps them trapped. Professionals avoid this trap by accepting a hard truth early. Not every movement is tradable. Most movements are noise. The goal is not to trade often, but to trade well. Lower time frames also distort expectations. Traders begin to expect instant results. If a trade doesn't move immediately, they panic. They exit early, only to watch price later move exactly as planned. Over time, this trains impatience. The trader loses the ability to sit with uncertainty, a skill essential for long-term success. In contrast, higher time frames train endurance. They teach traders to let trades breathe, to trust structure, and to accept that time is part of the strategy. The most tragic part of lower time frame addiction is that many traders blame themselves, not the environment. They believe they lack discipline or intelligence, when in reality they are fighting against their own biology in a hostile time frame. Professional traders design their environment to support discipline. Retail traders often unknowingly design theirs to destroy it. The illusion of fast money is powerful, but it is just that, an illusion. Speed does not equal skill. Activity does not equal progress, and excitement does not equal profitability. Those who survive in the markets long term are not the fastest. They are the calmest. They build systems that protect them from their own weaknesses. They choose time frames that reward patience instead of punishing it. Breaking free from lower time frames is not about giving up ambition. It is about redefining it. True mastery in trading is quiet, boring, repetitive, and deeply psychological. When traders finally step away from the noise, something remarkable happens. The market slows down, emotions settle, decisions improve, losses become tolerable, wins become consistent. Trading becomes what it was always meant to be, not a thrill ride, but a professional process. The illusion of fast money fades. In its place appears something far more valuable, clarity. In the world of trading, the loudest voices are rarely the most successful. Social media celebrates speed, aggression, and constant action. Screens flash with rapid entries and exits, bold profit claims, and the promise of quick wealth. Yet behind the noise, the traders who survive year after year operate very differently. Their edge is not flashy, it is not exciting, it is quiet, patient, and built on time itself. This documentary explores the silent advantage of higher time frames and how they shape traders who last. Most people come to trading with the same expectation: results should come quickly. This belief is reinforced by modern culture, where everything is instant. But markets do not reward urgency. They reward alignment with how price actually moves. Higher time frames reflect the true rhythm of the market. They reveal structure instead of randomness, intention instead of impulse. On higher time frames, each candle carries weight. It represents hours or days of collective decision-making by participants across the globe. Institutions, funds, and professional operators leave footprints here, not in seconds, but in sustained movements. This is where trends are born, tested, and confirmed. Lower time frames, by contrast, are dominated by noise. Price flickers back and forth as liquidity is hunted and emotions collide. While it is possible to make money in this environment, it requires extreme precision and emotional control. For most traders, the cost is too high. Higher time frames offer something far more valuable than speed: context. Context allows traders to understand where price has been, where it is now, and where it is likely to go. Support and resistance zones become clearer. Trends become visible. False signals fade. Instead of reacting to every movement, traders begin to anticipate scenarios. This shift from reaction to anticipation is the foundation of consistency. Professional traders do not aim to predict the market. They prepare for it. Higher time frames give them the space to do so. They can map key levels, define risk, and wait for confirmation. Decisions are deliberate, not rushed. Emotions have time to settle. The trader becomes an observer first, a participant second. One of the most underestimated benefits of higher time frames is psychological stability. Trading is a mental game before it is a technical one. Constant exposure to price movement can overload the nervous system. Stress accumulates. Judgment suffers. Higher time frames reduce this exposure. When traders are not glued to the screen, they think more clearly. They stop chasing price. They stop forcing trades. The market is no longer an enemy to be conquered, but a process to be respected. Consistency is not built on frequent wins. It is built on controlled losses and well-managed risk. Higher time frames naturally support this. Trades are fewer, but more intentional. Risk parameters are clearer. Stops are placed based on structure, not emotion. Over time, this leads to a smoother equity curve, not because losses disappear, but because they are contained. Another critical advantage is patience. Patience is not passive waiting, it is active discipline. Higher time frames train traders to wait for alignment. They learn that missing trades is not failure. Overtrading is. This mindset shift is transformative. Traders stop measuring success by daily profit and start measuring it by process. Did they follow their plan? Did they manage risk? Did they wait for quality? These questions replace the emotional roller coaster of short-term results. Higher time frames also encourage humility. When trades take days to unfold, there is no instant gratification. Ego fades. The trader learns to accept uncertainty. This acceptance reduces stress and improves decision-making. Many traders fear higher time frames because they believe slow means missed opportunity. In reality, higher time frames capture the most meaningful moves. Major trends unfold over weeks and months. Being positioned correctly in these moves can outperform dozens of small, stressful trades. Professional traders understand this asymmetry. One well-executed higher time frame trade can compensate for many small losses. This is how edge compounds. Another often overlooked benefit is sustainability. Trading should support life, not consume it. Higher time frames allow traders to step away. They can sleep, work, and live without fear of missing every tick. Alerts replace obsession. Structure replaces chaos. This balance is not a luxury. It is a requirement for longevity. The silent edge of higher time frames is not something that can be marketed easily. It does not produce dramatic screenshots or viral clips. It produces something far more rare: survival. And survival is the foundation of success. Over years, not weeks, traders who align with higher time frames develop intuition. They recognize patterns not because they memorized indicators, but because they observed cycles repeatedly. Experience compounds. Confidence grows quietly. This is why so many professionals converge on similar approaches even if they trade different markets. Time filters noise. Structure reveals truth. Patience protects capital. Higher time frames do not guarantee success. Nothing in trading does. But they create an environment where discipline is possible, risk is manageable, and learning is sustainable. The markets will always test human emotion. Fear, greed, hope, and regret are part of the game. The difference between those who fail and those who endure often comes down to one choice: the time frame they trade. The silent edge is not found in speed. It is found in restraint, in waiting, in letting the market come to you. Those who master higher time frames may never be the loudest voices in the room, but quietly, steadily, they are the ones still standing. Disclaimer: this content is for educational and informational purposes only. Trading involves significant risk, and financial markets are unpredictable. Past performance is not a guarantee of future results. This material does not constitute financial advice. Always do your own research and consult a qualified financial professional before trading.